So Houston fared better than most. No overbuilding. We avoided the mass layoffs. We avoided the housing bubble. And, you know, I just got back from Seoul, Korea, and Hong Kong. And I was over there on a trip. Our firm has the marketing assignment for Williams Tower. 65-story iconic building, and Hines really felt like we needed to do a road show. And so Tom Melody and I took that building on the road. And in Seoul, Korea, and Hong Kong, you know, we met with 17 different investors. The first part of every meeting was a 20-minute presentation on Houston, Texas, because they had no clue. Seoul, Korea particularly, no clue about Houston's story. I mean, honestly, I think the Asian investment community is more focused on, and rightly so, the coast. You know, San Francisco, LA, New York, Washington, D.C. So they like investing in what they consider to be the safe markets because what? Everybody else has done it. So we're talking to them about Houston. And I got one great question from a family investment group in Hong Kong. And he said, you know what concerns me about Houston is there are no barriers to entry. He's right. I mean, San Francisco is very zoned. New York City, very zoned. Washington, D.C., very zoned. All those are controlled communities. What does that do? That constricts supply. What does that do? That raises prices. Okay? Houston is blessed not to have that constriction, that there are few barriers to entry. What's controlling real estate in Houston today is the cost of capital and the availability of capital. It has nothing to do with barriers to entry, with zoning, no zoning, and everything else. And I had to go into a discussion with this group about, you know, Joel Kotkin's thesis on why Houston has thrived and other cities are not thriving anymore. I mean, look, Chicago's still losing population and employment. Okay, San Francisco's losing population and employment. Palo Alto's not, because technology is booming, but San Francisco proper, you know, they're not growing like Houston is, okay? They've been doing well, but they're not growing like Houston. The point is that this no barriers to entry saved us from a housing bubble also. Our home prices went up, you know, ours go up in Houston maybe 5% a year. Ours didn't go up 40% over 2 years. We didn't have this artificial ceiling like Vegas and Phoenix and you know, all along the California coast. It just didn't happen here. What does that do? It creates stability, right? We had fewer foreclosures than other major cities. We've had fewer housing problems than other major cities, and we've recovered in the housing market faster than anybody. And existing home sales are robust here. Because of the no barriers to entry, we can prohibit a housing bubble from happening, because the last guy to build a subdivision is not the last guy to ever build a subdivision. Somebody else can put up a competitive one with better homes and better access tomorrow if he wants to. So the housing bubble was very, very important to our economy, and of course the international focus. Houston is, and this really surprised those investors in Seoul, Korea, and Hong Kong, we're one of the most international cities in America next to New York. 92 foreign consulates are represented here. We have over 3,000 international companies in Houston. When you look at the trade with the Port of Houston, I mean, #1 in U.S. foreign tonnage, #1 in exports, the 7th largest port in the world, and we trade with 41 different countries over $1 billion each. Over $1 billion with 41 different countries. We're very international. When they saw the diversity of our population and the diversity of our economy, they were all rather shocked about it. So that's why we fared better. Also, we have 25 Fortune 500 headquarter companies in Houston. That's second only to New York, and there's nobody even close to that number. You know, we are way ahead of all that. So here's the long-term outlook, as best I can tell. Two things. Our population is going to continue to grow. And I just look at 2025 because, you know, I'm trying to pick a horizon here that's realistic for me. So 2025 looks pretty realistic. Another 12 years. What are we going to be? It looks, you know, from here, we're going to be another 2 million people bigger. Okay, we're at 6 million today. That was 2010 census. We're a little bigger than that right now, but so you take off a quarter, you know, well, another million bigger, another million in population bigger. That's a lot of people coming into Houston. That speaks to a lot of construction that's going to take place and development that's going to take place. Even more importantly, you can see the workforce is going from 2.66 to 3.3. Okay, so the workforce is continuing to grow, and that 100,000 jobs per year that we have cooking right now, even if it's slowed, you know, 80, even if it's slowed to 60, that's good solid growth. We're going to hit these kinds of numbers. So the long-term outlook for population growth and employment growth is very good. You know, I mean, the headlines just keep coming out about Houston. If you don't see them, you know, they're dynamite. The one I like the best is the one that just came out in July. Second from the bottom, Houston tops the nation's list for coolest cities. Imagine that. Not temperature, not temperature. We're talking, you know, we're talking about cool. You know, Apple cool, iPad cool. It's really strange. We beat New York, okay, and that's something that rarely happens. But it's because, and one of the new trends that's taking place in our city that's making this an attractive place to work after college. Well, first of all, a job, right? I mean, that's cool. Have a job, get a paycheck. Jobs are number one, okay? But an urban lifestyle, big on young people's list. If you look at what's taking place inside Loop 610 with all the urban development, if you just look at uptown Houston, the Galleria area, in the last 10 years, 14 high-rise and mid-rise residential projects have been built in the Galleria area. Uptown Houston has transitioned from what you used to think of, oh, just the Galleria, let's go shopping there. No, it's now the live, work, play area of Houston, along with Kirby Boulevard, along with Washington Avenue, along with downtown and midtown. Look at all the areas right now that are thriving residentially, with restaurants, clubs, nightlife, all the activities young people want, together with the sports teams and all the arts and everything else that we have. It's pretty neat to see us in that position. Lots of headlines. I can leave those with you. You can look up the articles if you're ever interested. A quick overview on the office market. There are some really strong markets right now. Downtown is very strong. Galleria West Loop is over 92.5% leased. It's hard to find a block of space over there right now. West Houston, obviously the energy corridor is very strong. Our firm in the last really 24 months, we've done 10 of the 15 lead tenant deals that have kicked off in Houston for new buildings. We've done 10 of the 15. And we did, just in Memorial City, we did Nexen Energy, which was just topped out and finished, and now they're building the Murphy Oil building right there next to Dennis Seafood. That'll be another 300,000 square foot building. We did the lead tenant deal for Samsung Engineering in West Chase, being built by Behringer Harbor. So there's some construction activity taking place. There's some lead tenant activity in West Houston. It's really hot, and it's real simple. When you work with these companies, you start to see what's happening. I mean, if Murphy Oil is an example, I mean, they're like the Petrohawks, or well, Petrohawk was bought by BHP, but they're like Nexen, Murphy. These independent oil and gas companies are hiring like crazy. The CEO of Murphy goes on to college campuses himself to recruit engineers. And he got 17 of the 20 he went after. And when your CEO considers one of his most important jobs, in addition to drilling for oil and gas, is to bring new talent into his company, he's sort of leading the pack. So the other trend that's taking place in the office market is that companies are looking for amenity-rich locations. They no longer want, the isolated campus out there. Of course, if you're Exxon and you want to build, 2.5 million square feet and spend $2 billion, you can build your own infrastructure, your own fitness, food, and amenity base. But if you're like a Nexen or a Murphy, you're only a 175,000 square foot user. you need to be next to amenities that your employees can walk to, participate in. Memorial City Mall, is right there. Restaurants along I-10. Shopping. Valley Fitness right across the street. So you've got all the amenities that the workforce wants, and that's what they want, an amenity-rich location within walking distance. So that trend is really helping the strong markets with more amenities, and not so much those that are more remote. Cost control for tenants is the name of the game, because we're transitioning into a landlord-favorable market. It's more difficult to get, that last penny of negotiation, that last dollar for TIs, free parking, free rent. Most of that has basically gone away in the strong markets. The landlords are in the driver's seat, and they're pushing rents higher. And that means long-term, our larger clients are securing space for 10 years, 15 years, and 20 years now. Because it appears, unlike the 80s, there's not going to be an ever-ending supply of space on the market for them just to pick up and move to. That day might be changing. I'm not going to say it is for sure, but it might be changing. You should be prepared for it. So longer-term leases are becoming more popular. And absorption and rents are going to continue to grow. Our office market, if you look at this slide, there's a couple of things we're tracking here. One of them is the unemployment rate. And I hope you can distinguish the colors there. But, as unemployment declines, absorption goes up, vacancy goes down, and new deliveries increase. So the real estate business is really tied to employment numbers. Well, employment numbers are driven by the rig count, the energy industry, the Eagle Ford Shale, the Texas Medical Center, the port, NASA, all that, all the continued growth in our diversified economy. So you got to watch the unemployment rate also. It does affect the thinking in the real estate business, and it does change the market because the more workers we have in the marketplace, the more office space we're going to absorb. This is what we call our property clock. It'll show you which markets are already recovering and in a rising situation, which ones have stabilized and are still falling. It also says that if you're looking for space, the best deals might be in the North Loop or the North Belt right now, because they haven't fully recovered and there's a little more availability in those markets.